Social Security is a key part to nearly every person's retirement plan. But how do those benefits get calculated? My name is Will Goodson. I'm a financial advisor with Financial Synergies, and that's what we're going to cover in today's video. So let's check it out. Social Security uses a two-part formula to determine what you're going to receive when you file for your benefits in retirement. The first step is calculating what's called your average index monthly earnings, or your AIME. And this is essentially the monthly average you earned over your lifetime indexed for inflation. So those early years get indexed up into today's dollars. And what they do is they look at the highest 35 years of income that you have and they add that up. And that's what they're going to use for calculating this number. Now, some people will ask, what happens if I haven't worked for 35 years? Well, they're still going to use 35. So any year short of 35 that you may be, they're going to input a zero. And the more zeros you have in that calculation, the lower your benefit is going to be. On the other hand, if you've worked for more than 35 years, they will always replace lower income years with higher income years. It is always designed to pay you the highest benefit possible. So if you had really low income when you first started in your career, if you started working at a younger age, and as most people do, their income increases toward the middle and end of their career. If you go over 35 years, they're going to drop off those lower earning years and replace them with the higher ones. So they add up all of those earnings. And again, on your statement, it's going to keep a running record, a record of your earnings over the course of time. They also keep track of the taxes you and your employer have paid as well. So they're going to add up those 35 years of earnings history, and they're going to divide it by 420 months. Again, 35 years times 12 months in a year gets you 420. So that calculation equals your AIME, your average index monthly earnings. That is the first part of the calculation. They then take that and move on to the second part of the calculation, which is determining what's called your primary insurance amount, or your PIA. And your PIA is essentially 100% of your benefit that you're going to receive when you reach your full retirement age, which is between 66 and 67. And they take that AIME number and they run it through a kind of tiered calculation known as bin points. And as you can see here on the slide, the first $1,115 you're going to get 90% of that. The second tier is any amount over that 1115, between 1115 and $6,721, you're going to get 32% of that. And then if your AIME is high enough and it exceeds that third tier, that 6,721, then any amount above that, you're going to get 15%. And then they go through and they're going to add up each of the tiers that apply based on your earnings history, based on that average amount. And that is your PIA, and that is what your actual monthly benefit is projected to be. So if we look at an example, let's say a person, their average index monthly earnings was $8,100. Running through that calculation, the first 1,115, again, you get 90% of that. So that equals $1,003. The second tier is the difference, again, between the 1115 and 6,721. So that's $5,606. You're going to get 32% of that, which equals $1,794. And because the AIME number was 8,100, it exceeded that third tier, you're going to get the difference between the 8,100 and the 6,721. In this case, that would be $1,379, and you get 15% of that third tier, which in this example equals $207. So then adding up those three tiers, this person's projected benefit amount, their PIA, is going to be equal to $3,004. That's what they would expect to receive when they file for benefits at their full retirement age. I hope you found that information helpful. If so, feel free to follow along our channel where we talk about everything related to financial planning, retirement, and investing. Thanks for watching, and we'll see you in the next video.